Hey, fellow traders. Got quite a video in store for you today because I've actually come up on something that seems a bit insignificant but turns into some rather seriously large trades. I actually just made a post where I actually had a position that started about here. I had about $2.04 of risk at a size of 0.06. And I ended up actually closing that one out manually. I ran out of patience of holding it and actually closed it out right there. And I'm actually using only a couple of simple things to make this happen. I know it looks like it's kind of a messy chart, but I'm going to go over exactly what you need to do this. And I'm actually in a trade right now that would kind of demonstrate what I'm about to show. I just actually took this entry right as I was starting up the stream or the recording. To all the new viewers that are just now finding the channel, welcome, and big thanks to all the returning viewers and subscribers. Let's go ahead and get into what I've got going on. Now, I was actually trying to plan out another video as I discovered this, but basically in order to uh, make a trade like this, all you're going to need are just a couple of things. We're going to need a simple 2-minute chart. We're going to need this dinky little box. And we're going to need a dinky little line. And then we're going to need one indicator, but we're not using the indicator really to take entries or give us any signals. We're really only looking for a couple of different things to happen, and that just means that the conditions are set up for us to look for a trade, or if we're in a trade, we want to get out of it. So basically, the way this kind of works is we know we're looking to basically take a trade, and whenever we take a trade, we have this risk here. And let's say we wanted to target this level, and notice that that's only like a 2.5 to 1. And as far as risk reward ratio, and if you really wanted to get a big rip, you're going to have to hang on to this trade probably forever just to even try to get an 8 to 1. That's probably going to be a couple of days to get something like this out of the euro. But if you were to target that and you still needed or could possibly get a higher risk reward ratio, the way you make that is by making this smaller. Notice how fast that number goes up just by small little movements. A couple of little ticks and it's going up full numbers. And this is the whole idea. Not sure why it's asking me that, but this is the whole idea of what's behind what we're doing with the box, the line, and the moving average. Now I'm going to go ahead and open this up real quick and we'll take a look. Everything is a simple moving average. We don't want a weighted or linear or EMA or volume weighted. No, we just want a basic simple moving average because we want to know as quick as possible when does price stop moving, and we'll go over that in just a few moments because this little setup right here and this line as well will also tell us both of those things. Just leave it set to chart, wait for time frame closes, and it will stay pretty smooth. Set your colors if you like. I like red for the slower one and blue for the lighter one, and then you can change your line style or size. I usually go with a little bit thicker line to see it on the second tab. It's just the MA ribbon, and if you want to add that to your chart, instead of adding just a couple of simple moving averages to kind of save your script collection in the corner here, if you're using a lower or free version of TradingView, they don't let you use too many. Just type in moving average, and you want to look for the moving average ribbon, and that's going to give you 4 moving averages. We just need to select 2 of them, a 20 and a 200. Both are simple. Now this is going to be our 20. We're going to kind of use this to help us hang on to our trades and to more or less spot when this kind of movement stops and then consolidation starts, because once we have consolidation, that's when we're going to look for our entry. Now notice already getting quite a significant amount of movement, and that is only a 2.7 pip stop loss. I've got the stop right under the breakout candle, and I'm just taking immediate entry on the confirmed breakout of the box. And that's the entire strategy in a nutshell. And then you're just targeting a key level. So for this one, we've got this little support area, dinky little line, and I'm going to come up just shy of that for the target, and that's going to end up actually resulting in a 6.5 to 1. So that's going to be quite a significant amount, and we're only going 17 pips, give or take. So that is actually going to generate basically a huge, massive return of multiplication of the risk. And if we lose, we still only lose just a little bit, a very tiny amount. We're risking $1.50, and we're going to make 10. And right now we're getting a strong push. And what we could actually do in this case, before I get too far ahead, I'm actually just going to move this up to make it almost risk-free. So now we've got 2 points for the stop loss on it. So we'll start going over sizing, things like that in a minute, but let's go ahead and get into how I got this set up and how I got the entry out of this setup. So right now we had this long pronounced downtrend. I actually hit that right as the Tokyo was getting in. I had a long here based on the breakout, but we had a key level that was basically support before. It got up, started to show support, but then it made a rather large engulfing candle here and engulfing candle here. It broke back below that level, so I just took the entry. I was trying to set a limit, but it got me with spread, and basically tapped me in on the account here, on the paper trading account. So I just held it out and covered the highs and just let it ride all the way down. And then finally, I couldn't stand it. That's something I'm working on, is hanging on to my trades. But I just couldn't stand it anymore, and I closed it finally. And actually took a 852 on that one, and I didn't quite hold it all the way to target. But I did actually set this one last night on the Zoom, and actually ended up making $23.94, and I think I had $3.20 of risk on it. And that one actually ended up, I actually caught this one here on the Zoom. I took, believe it was this candle, either that candle or that candle. And then I took it all the way down to here, and then I ended up catching it again on the breakdown here, covering the highs. And that trade actually ended up coming down. I didn't actually put this trade in the account. I had it on, but I took it off because we had news coming. But I left the marker on, and it actually came all the way down just as I had intended. I just didn't hang on to it long enough. So I've really been needing to work on staying power in the trades. So hopefully this leads to further things, but I think this is going to be a pretty good strategy to stick with in the long term. But let's go ahead and get back on track. Sorry, I have been awake forever and a day, and I am not quite sleepy. So I'm just going to try to push through it. If you bear with me just a moment, we'll make it to the end, and hopefully I will not over-engineer this. So basically what we have going on is you're going to have price. It's going to be, oh my goodness. It's going to basically be doing its own little thing, and then all of a sudden you're going to notice it's going to start making little highs, little lows, but it's going to not really be doing a whole lot. It's going to just kind of dilly around for a minute. And what you're going to have on the next part is your 20. As soon as it starts doing this, your 20 is going to immediately go flat. It's going to just stay flat, flat, flat. It's going to act just like a VWAP almost. the volume weighted average price, if you're familiar with that. But basically, it is just not going to move despite price actually moving. So let me change the color of this so that way we know. And that's the 20 SMA, the simple moving average. If you put it on exponential, it will not hardly go flat, and we want it to go flat. So by setting it to simple, as soon as price starts doing this little bit right here, that 20 will go perfectly flat, almost. And that's what we're looking for. And then once price starts to go flat, once that 20 SMA goes flat, or you start to see price consolidating, you'll notice that you have some highs and lows. So you're going to basically take your first low and your first high, or vice versa. So you have price already starting to form up. You're going to basically take the box and pull from the high and the low. And for as long as price continues to just doodle around in this little area and do its own little thing, it might wick out and come back in, wick out a little bit, come back in. But the whole time price is sitting in here doing its own little thing in here, we are sitting here watching it. And what's going to happen is you're going to wind up with a range that's usually 2 to 3 pips wide when this happens. And now all you're waiting to happen is usually price will go the opposite direction first, but not always. So what I tend to do is as soon as you have a close of a candle, or the candle starts to actually noticeably reach out of the box with some type of engulfing candle. And what I mean by engulfing candle or large candle, it's basically just going to be a full body candle. It's going to be green or red or uh, whichever color that you'd like, but it's going to basically be a strong, solid body candle, and it's going to start pushing out of the edge, out of this box. As soon as it starts to push out, if you're near the end of the close of that candle, jump in. You're going to immediately jump in long in this situation, and you're going to cover the low of that candle after it closes, or you'll cover the low of this box. And notice that's about 4.7 pips. And then if we were to try to aim up, we can get some serious R ratio in just small amounts. We can, just between a 4 to 5 pip variance, we can change that from a 4 to a 6. So basically what we're going to do is once we have that entry, we're just going to target that next level and wait. Now you may occasionally want to move your stop. I noticed it did come down and tap our stop, so we lost nothing. Basically lost about 4 cents. I've got the commission set up even though it's not exactly right. But now I would sit here and watch this. I probably could have just left it. Probably should have just left the stop down there for that occasion. I'll throw another one on there, because that's about where I had the entry anyway. Cover the low. So we got $1.68 in risk, and put that target right back up here and walk away. So we'll try that again, because right now we're above the box. It's coming down. It kind of makes sort of that retest. This is actually kind of a variation of that grow an account fast 15-minute strategy that I have. I'll probably put a card for that somewhere in the video so you can check that out. It uses a little bit of compounding because it has a little bit. It's not exactly the most reliable hit rate. But now that I've taken that entry, you'll notice that even though the account's $160, I'm using a 0.06 and only risking $1.68. I did this kind of on purpose because at $150 I can afford 0.06 with the margin in the USA, because we have 50 to 1 margins. So that would be the maximum size. And basically for every single trade I'm doing full send maximum margin. So with these small pip amounts, this one has 2.8 on it, so pretty similar. Going for a 6.5 to 1. These actually get hit pretty consistently. So far I've hit a 4, a 5, and a couple of 6s. I've also got a test where I kind of was toying around with the idea before it came to full development, where it was actually hitting at about 60%. And so far that's kind of being maintained with some of the forward testing that I'm doing. But that's all you're basically doing. So I mean, in this example here, if you were to, same thing, you start to close down, you just immediately go short. If you have a strong candle, a full body engulfing, an elephant bar, Maribuza, goes by several names, but it's just a full body bar that's going to be larger than the rest. So I mean, you're going to see basically, some smaller candles. It might be like, one might be like that. You might have a little bit of a doji. And then, just some other little smaller candles where it's not really doing anything. But then all of a sudden you're going to have this candle. Too much stuff in the way. You're going to have this candle, and it's going to be significantly larger than the rest. It's going to be bigger. It's going to stand out on the chart. And these are the only kind of candles you're really looking for beyond the pin bar type candles. So if you have something, some may call this an inverted hammer, uh, a gravestone doji. Let me get that adjusted. Bada bing, bada boom. So this might be like an inverted hammer or a gravestone doji or whatever it goes by, but it's going to have a long wick and then it's going to close down. You're going to either see a candle like this or a full body, fully filled in candle that breaks out of this box. Once it breaks out of that box, you immediately take the entry. So even though this candle is not completely formed, it's already cleared out the lows of at least 4 to 5 candles. Once it starts to clear those lows, you can safely go in, get a very close and tight stop around 5 to 6, 8 pips. You really want to try to keep that under 10 pips. The smaller this is, remember, the smaller this is, the more you can multiply your risk. And if you're putting the same amount of risk into every trade, then the smaller you make this, if this is $1 and that is $1, well, if we multiply $1 times 1.5, that's $1.55. But if you're risking $1 and you're multiplying it 5.5 times, that exact same distance of target now becomes much more valuable. So you want to try to wait for that 20 to go flat, pull your box from the highs to the lows, ignore the wicks. You want to get a close or a candle that's pushing out fast and hard, or a candle that's already outside and near the end of the close if you have a candle timer, or if you turn on your countdown to candle close in TradingView. You want to try to be near the end of the close of that 2-minute bar. And the reason I'm using the 2-minute instead of a 5 or a 1 is because I'm kind of looking at a finer detail. It's a little bit more sensitive to the breakout. So if you're on a 5-minute candle, for example, see, this starts to break out at the beginning of the 5-minute, but if you waited until the close, now your price is all the way up here. This is actually 6 minutes between these 3 candles. Each candle is 2 minutes of price action. So that would be minute 6 by the time you get in. Whereas here we already have the confirmed close a couple of points outside the box. We could go ahead and take entry there had I not been on somewhere else. I actually got the entry here trying to start up the recording. So you ultimately want to grab that entry there to get the absolute tightest stop. So we see these wicks here. You can cover the bottom of those wicks, get 2 to 3 pips of risk, and then look at how significant of a multiplication we can make. We can take a 1 to 4 in 10 pips straight back to the 200 if we wanted to, if that was one way you wanted to attempt this. I usually like to target key structures, and this is going to return anywhere from a 4 to 8, sometimes even a 10R trade. And they're hitting about 5 or 6 out of 10 usually. because a lot of times when it breaks out from a formation like this, even though we're on a downtrend, it is very likely to continue up at least to the next major level. So you're going to find a place where price is flat. Notice it's kind of flat there. It's kind of flat. We had a wick off of this area. It's flat. You're just looking for something flat. That's the best way I can kind of put it when I'm talking about support and resistance. Just looking for something that's flat. Notice how consistent this stays all the way through to the chart, and once price comes back, it will probably use that level again. So just look for something flat. That's probably the easiest way. So you could probably even say that's a level, and if we move it back, well, would you look at that? It lines up, makes some more flat. That's kind of noisy, but notice the wicks are bouncing off. It's rejecting off. It's staying in a range. You can kind of zoom in. Notice how they're not exact, but they're going to be kind of close. So if you see a bunch of little actions, a bunch of little bumps in your path, like when we start going up, these little bumps where we came back down are actually going to cause price to hesitate before going through. So don't let that scare you out of the trade. It didn't quite happen here before, but notice we had this level here. It ignored it the first time, but then it actually used it the second time, and then finally went back down. So these levels, they may not get used the first time, but they will usually cause some interference along the way. So some just keep in mind while you're holding your trade. Or what I would highly recommend is just to set it at a key level. Once you have your entry and it starts to move a little ways, you can put it to break even or even just cover if it makes new breakouts. So like we don't really want to try to do this on a trend, but let me go back here where it's a little cleaner. But let's say, for example, we were watching price and we were saying, okay, we wanted to catch, we see this little area right here. So we might say that's a little zone, and if price breaks down out of that, we want to take it either high or low. Because right now it's kind of in between this range here. So we don't know if it's going to continue up or continue down, but it did start to range, so we're just going to watch it. And then let's say we missed it because we had to go to the store or something. So we miss it. So all we have to do to repeat this process, and it's really not recommended to get in, especially on a long trend towards the, after it's been going, it's already tapped the 20 or tapped a trend line a few times. But if it's going down and it's still kind of close below the box and you want to get in, all you have to do is that same idea when price is moving flat, just treat it as if it's moving flat. So as you can see, it's starting to pull up, it touched the line, and now we're staying inside that zone, inside this area. Now once we clearly break out and hold below, this would be your entry for a trend continuation, and you're still using just that dinky little box. Once you pull a high and a low, something that's pretty clear, pull the box over. As soon as it starts to clear and close below, you could actually take that. You may have a little bit higher risk on that trade, and you may not get as much. Typically, I recommend targeting 1 to 3 to start with, because you only need to win 1 out of every 4 to actually break even. And oftentimes that will work out to get hit, even from a late entry, and that'll also work out with a little bit bigger stop. But just keep in mind, you want to try to keep that stop under 10 pips if at all possible. And that's why I kind of recommend using the 2-minute chart for this strategy. So right now, let's see how we're playing out. Kind of at the end of the Tokyo session, so we can't really expect a whole lot. I was really surprised we got this strong move out of the open of the Tokyo. About an hour into the Tokyo, it started moving. I grabbed that trade there at about an hour and 2 minutes, 3 minutes in or so. Maybe, I'm not sure. I was kind of busy. I know I did grab that candle. I was trying to set a limit, and then I was trying to actually get in on this candle by limit, but it grabbed me in, so I just held on from there. And then once it started to stall, actually, I think I may have taken it right around in there. for a 1 to 4. Yeah, that's where I actually ended up taking that. And that actually netted $8.50. And on a $150 account, that was uh, about a 12% gain in just one trade. And that was only 16 pips to get that done. So just remember, the smaller you can make this, the more of these you can pack in there. The only thing to keep in mind is once you start getting larger, like for example, if you were to get up near one lot or 1.5 lot, you may have a little bit of slippage. So you may want to try to stick to something such as the London or the New York session. You'll probably end up with a little bit larger stop, but you will have a uh, much better likelihood of actually getting your orders filled at or near price and actually getting your orders consistently filled without a lot of slippage. Now, you still probably get some slippage at size because, of course, not everybody is looking to buy a lot. You may have to wait for it to get pieced out, but just keep that in mind with these tight stops. You have to be kind of careful about sizing up and keep in mind with slippage. Now, you are going to also want a razor account, a zero spread account, because trying to fight with these tiny, these really small stop sizes, you are going to end up getting hit by that spread a lot for no reason. It's just going to drop you're going to have a loss of liquidity, loss of volume, and all of a sudden that spread is going to spike wide. It's going to knock you out, and price never did anything at all. So it's highly recommended to use a razor account to do this. And commissions are also something to keep in mind. Try to find a broker that offers the lowest commission. I know, as far as I know right now, Forex.com in the US has $5 commissions. I'm not sure of any other brokers who offer lower than that. I think $5 is pretty standard around the US, $5 to $8. Oanda is 10, IG is 8. So just be mindful of your commission costs if you're going to try to use a super tight strategy like this, because if you don't get enough of a target with a high commission, you're going to actually end up, like, say for example, this is 2.2 pips and 10.7 as the target, but if you trade this on Oanda paying $10 commission, you're actually going to you're actually going to get a 9 pip win after commission and a 3.2 pip loss. So instead of being almost a 1 to 5, that's actually a 1 to 3 after your commissions. So trading costs are going to play a significant role when you're trading super tiny like this. But by trading with a super tiny stop, you can pack a lot of size into that position, and you only need a very small amount. I mean, 3 pips in profit, and we've got 1 to 1. I mean, it is literally that quick. And you're going to end up, once you hit a few of these in a row, you're going to significantly push the account up. Even if you lose 5, 6, 7 times in a row, you're going to end up actually pushing the account back up and making a gain just naturally from one trade because of how these are. Just keep in mind, look for the flat spots. You'll either have a clear definition, but you'll want to include the wicks, the highs, and the lows. So we have right here this little high and low. So we'll include that in the box and extend the box over. Once price cleanly comes out of it, take the entry and ride it as long as it will go. If you start to see little pullbacks or something like this over the line and it goes back down again, you may want to trail your stop down. Just cover your highs, and every time you get a big candle push down or a strong candle push down, you can actually put your stop directly above that candle. And then as it moved down here and crossed over the line, you may want to consider closing here if you hadn't already. See, I'm trying really hard to handle myself while hanging on to these larger size trades because I'm very tempted. Even at like a 1 to 3, 1 to 4, it's like, wow, that's really good. Let me just take that. But no, I really need to get good at hanging on to these, because the hanging on to the winners makes a significant difference in the long run, instead of just taking a 1 to 3 and then you jump in, take another 1 to 3, jump in, take another 1 to 3. So you paid 3 commissions instead of 1, and then you also risk giving up your gains as a loss with that commission. So technically that actually ends up to losing faster. So the longer you can hold a trade and the better off you can plan for a trade to go and hang on to it, and that's not going to work. Now this would be a good example. Let me close that out. Oh, my bad. Forgot to change the size. Okay, put that back to the right size. Now for this one here, because it's a very strong candle, we're breaking out. You see the momentum in the candle. That could have actually been a good entry there as well. Notice how that candle took out several. You can directly use a candle like this for an entry. So right now we weren't quite near the end of it, but it's getting such a strong push, such strong momentum. This is actually how I got into this before. Up here we started to get some really strong momentum, really strong hard pushes down, a lot of volatility right there. So that was a good indication that we're not going to stay over this level, so we're definitely going to go down to another key level. And this is what I'm going to plan for the next trade, and just let it ride. If it goes, it should go. If it clears that box, and then stop is right above that candle, and I'll look back here and see if there's anything to target. We'll look for a key structure or key level or any kind of flat zone or significance. I'll have to move up on my time frame here. And I would think for here I might actually pick right there, because notice there's flats right there in that zone. Might even come down a little bit more, get a little bit deeper into that. But notice it's clean here and a lot of noise here, so I'm going to look for a price to actually start hesitating and stopping there. So I'll leave that trade on. We'll see where we go from there. And we have $1.32 of risk. Stopping on the top of that candle, making almost a 9-1. We had 2.2 pips. So just by shaving that half a pip, we got 3 more R out of it. So the smaller you can make that risk, the higher the R you can get. That is one of the easiest ways to increase your R ratio without having to go for a longer target. So I'll leave that on. This is just still a practice account. I'm pretty sure that's probably going to end up falling out. We've got a lot of downward movement. We're on a downward trend. You don't have to analyze 5,000 different time frames and charts. I mean, you can put your your day dividers on. Okay, that was a day. That was a day. Okay, yeah, you might see some different price action and candle setups, so on and so forth. But honestly, I kind of refer to time frames as risk control. But then again, the market itself will actually give you structure for your risk. So you actually control your risk by your structure, and you can find your structures based on your time frame. So if you're moving down, I actually like to, like I said, I prefer the 2-minute here. Lately, it's very, very fine and filtering, but it's not extremely noisy or chaotic. It's still rather organized, like a 5 or a 15. And it actually works very well at identifying the strategy. So notice here we had another box. And had we been paying attention, we could have actually taken the break out of this box and been way up here. Go for the same target. And we'll get a little bit better. Get this out of the way. Okay, so what are we looking at here? 936. And then we could cover there. So we'd get about the same R, about the same distance. But then we would actually be better off there, because now we could actually come to the top of that candle and get very tight and have less than $1 risk on that trade, and no worries at all whether it goes or not. Even if it goes halfway, we can bring our stop down, and if it comes back, so what? We still made 4, 5, 6 R in 21 pips. So it doesn't take very long for price to travel 21 pips, but it will take forever and a day for it to travel 300. So just try to find the tightest spot possible using the dinky little box. Once you see that little collection of price, draw the box on a break, take the entry immediately, cover the high of the breaking candle or the high or the opposite side of the box. Let me get my computer plugged in. I meant to do that a second ago. Before we lose the video. Goodness, why can't I find it? Battery is low. I see. Okay. There we go. Save today. And I think that should probably actually do it for wrapping up the video. Looks like we're starting to get some progress now on our trade. I would let it go a little bit further. If we do get a nice bearish candle to break this low, that would actually be a good opportunity to bring up that stop. I noticed that we got two wrong. Count balance hardly moved because we had a very small amount of risk, very large size, and if we do get this right, it's not going to take much to wipe out that little bit of loss that we made, which, let's add that up. Where did we make those trades? Right here. So we had about close to $2, $1.75, $1.80. And we'll have that in just a couple of pips. So that's going to recover those two losses extremely quickly, and all of the rest left will be gained. We just have to be patient and wait for the target. So I'm just going to walk away from this, leave it to go, and come back and check on it later, because I think I need a nap. And I will catch you on the next video. I will continue on with the plan video. I've got a few other things coming up in the near future, so just stay tuned. I've also got a performance kind of tracker, so if you have a strategy you want to test and you don't really want to invest in in some high-end backtesting software, because it can get rather expensive just for backtesting, this sheet will actually allow you to track and keep up with how well your strategy is doing. I got to do just a little bit of reorganization to make it make a little bit more sense, and then it will be good to go. I'll have that coming out here soon as well. But definitely give that some backtesting, give that a try. I'm going to be running this forward some more. I've got about 12 to 13 trades on this, and so far all of the results have been extremely positive and powerful. Just look for these large defined candles, make the little box, use your 20 EMA. Also, same rule applies. Notice how here we had both of them flat. Usually when you have both of them flat and a move, it will usually result in a fairly large move when they're together and then start to split apart again. This here, I did take long, like I say, and then we had the level there. It didn't stay above it, so I just went short and held on, and it actually worked out with a very small risk. This one had, like I say, about $2.04 of risk. Ended up making the $8.50 on that, minus commissions was about $8.20. So really good trade for that, and it actually wiped out a handful of errors that I made while trying to anticipate too much. That's one of my other bad habits I'm working on. So I have a video about figuring out troubleshooting and fixing bad habits coming up as well. I'm going through quite a lot of different learning experiences all at once, and just funneling and filtering them all through. And it looks like we are good to go with that. I will make it right above that last breakout high. We have another little box. So anytime you have these little boxes, just go from the low to a high, and if price broke out of that, put your stop above the box. So this is basically risk free. Walk away, see if we get a $12 return. off a little over $1 risk. And there we are, going back positive. We've made back our losses, so now anything else from this point on is gain, just like that. So I will catch you on the next video, and enjoy, have a little fun with that. Do some experimentation, and then send your account straight to the moon, because this is going to allow you to lose several times over, and one win will knock out 15-20 losses. So no worries about losing at all. Just let it rip. And I will catch you guys on the next one. I appreciate you stopping through the whole video, and have a great end of the week.